everyone. Welcome to episode 6 of Making Sense of Sense. I've been getting some messages recently from listeners across the pond here in NYC, literally across the pond we call Central Park. It's great to know we have local listeners here as well. Right now on the market front, markets are currently seesawing as expected, given the various headwinds, especially now leading to the midterm elections and the Fed's proposed hike in November. The midterm elections are in a few weeks from now, and since September's CPI reading was pretty disappointing and came in higher than expected, we must now anticipate further rate hikes on November 2nd of presumably 75 basis points to curb inflation. However, even if the Fed continues to hike until 2023, which is expected by some reports, the spending sprees and higher costs at the pump to the shelves at the grocery store may not go away immediately. And consumers tend to be still pretty resilient, and it's amazing to see just their buying habits till this day. And luckily, with elevated inflationary levels, the best thing we can do right now is take charge of our cash, eliminate debt naturally since inflation erodes it. So take on more side hustles this way to earn passive income on the side, to directly reinvest into income producing assets, such as short-term guaranteed fixed rate treasuries and real estate, perhaps on the crowdfunding front or through e-REITs, a type of mutual fund that's publicly traded. Over half of my net worth personally is in real estate for this reason. It's a defensible, inflationary-proof investment that offers two kinds of returns in rising rents and price appreciation. And with higher cap rates and yields and lower valuations, finding a residential multifamily property or even commercial office space deal is easier said than done, at least in the last 2 years, where there was a lot of froth, overvaluation, and of course, speculation and a lot of fundraising going on. So it was difficult to see past the fog. And now with higher inventory levels, given higher mortgage rates, it's easier to see and identify possible deals. With financials and bank earnings, along with the Tesla, for example, who reported this past week, it's safe to say that earnings were unexpectedly expected. Tesla reported a Q3 revenue miss. However, the valuation reached the elite $4 trillion club, while Netflix, which I was surprised about with its new ad tier model, had an unexpected boost in viewership and memberships, and with over 2 million new subscribers, I believe. You can fact check that onto its platform, getting a nice boost in post-day trading for sure, and a surge in its price. Financials earnings were a bit murky, but that was expected since deals in investment banking, since their higher borrowing costs, have slowed tremendously. And of course, all kinds of portfolios, from retirements to Roth IRAs, growth, except for maybe private equity through prime brokerage and hedge funds with their asset dynamic allocation approach with selling calls and buying puts. Are getting an unexpected boost nowadays to hedge against inflation. But otherwise, majority of portfolios are down, given that equities are down over 20% this year alone, alongside just bonds and fixed income down, respectively 9%. In other news, although retirement portfolios are also not faring as well as they could, especially for those who planned on retiring this year, the cost of living adjustment, COLA for short, is expected to increase for Social Security beneficiaries, which is a really relieving sign for them, I'm sure, and a hopeful one that the government is taking inflation seriously. And for those with no active income in retirement, this is definitely a major boost in their lifestyle and adding a source of active income. And speaking of lower costs, Taxes are also expected to decrease, I read, given inflation hasn't always kept up with wages or vice versa for most workers in most sectors of the 11 sectors total, and across the nation. And it's a little overdue. Wages should be keeping up with inflation. But it's good to hear that the government is watching over Americans and helping relieve the burden of higher taxes and higher costs. But we cannot forget, don't fight the Fed, nor really rely on anyone except yourself, especially in a bear market. That's my piece of advice, and I think it's pretty solid and has helped me at least. In times of uncertainty, you really want to rely on yourself the most to weather any storm and hedge against inflation in this case. After all, if you aren't willing to get your hands dirty, then expect to not get that far, I would say. Sacrifice whatever you're willing to lose. That's risk-taking 101. Welcome to Econ 101 there. Speaking of higher costs and also the holiday season rapidly approaching, which starts, it feels like a year in advance. I'm already seeing Christmas commercials. I wanted to talk about the power of gift giving and giving back. Personally, I've never been a terrific, tangible, materialistic gift giver and shopper since I don't spend much on tangibles or materialistic goods myself as kind of a minimalist, frugal individual and spender. However, others may appreciate it, and holiday shopping is one of those activities that if I could, I would outsource, but unfortunately, it's not always possible since you have to know the person to get them the right gift. So I tend to go and lean towards gaining experiences instead for someone. And recently I wrote about this on how spending money on others is actually one of the most blissful feelings that you can give yourself, especially when looking at opportunities and experiences that you can get for someone. Not only does giving back to others feel good and to show your support, but you also get kind of a morale boost and a return on your investment as long as that relationship, of course, stays intact and stays strong. I was told this back in high school, and I'll never forget it. A network is an insurance policy money cannot buy you. Referrals are like currency, I've been told, and what you do with your currency, it adds up in a piggy bank and eventually pays dividends over a lifetime as an appreciable investment. Now, on that note, I'm not encouraging you to treat any connection or relationship as an exchange or contract. In fact, that's what gets people in trouble when they associate a relationship with a currency or just an offer or a trade. Instead, you need to be patient with it. Spending money or wasting time, I would say, is never really a waste of time as long as you enjoy it. If you feel the need to give a gift to someone, fill them up with experiences and try that out, or just life's simple pleasures that may not have any cost at all. After all, I always say that the best things in life tend to be priceless, and so I would go forth with that. So there you go, folks. I hope you give back in any way this week, since the best gift is giving after all, and stay patient and don't always expect anything in return. A connection isn't supposed to gain you an immediate short-term investment right away. True passive investors earn the real returns, which take patience and good timing, after all. So as always, like, subscribe, comment, question, whatever you need to do to help support us, and tell us what you're looking forward to hearing next time. In the meantime, make sure to invest in yourself daily, only 2% daily, as I say, and of course in others and in your relationships. It's worth it down the road, trust me. You never know what will come out of putting the investment in yourself and in others now that will yield dividends in the future. So thank you and have a great week.